So I'm not forecasting recession, maybe not, but those are very, very kind of scary numbers in terms of growth. It's one reason why we're not going to get any inflation. But I don't see any prospect of significant inflation. Now, your energy prices are skyrocketing as Canada may do okay in the U.S., but Europe and China are going to freeze in the dark. I know that's a cliche. I hate to use cliches, but this one might actually be true. Seriously, there are going to be fatalities in the UK and elsewhere with what's coming this winter because all the misguided so-called green policies and turn off all your nuclear reactors, turn off all your coal plants. We actually need a little more CO2 to keep the plants alive, but Germany did what they did, and Putin is dialing down the tap. And we'll see what happens. So natural gas prices are skyrocketing. Oil is not far behind. Absolutely correct, but that's not the same as inflation for a couple of reasons. Number one, it's not broad-based and persistent. Number two, I always say that if, sort of Sun's idea, if you want to understand the enemy, you have to think the way they do, not the way you prefer. And so if you're trying to think like the Fed, which can be painful, but the Fed excludes that. They look at non-core, core, and I know most analysts laugh and go, well, you got to get groceries and gasoline, so why not look at non-core? Okay, but the Fed doesn't. They look at core PCE year over year, and when you take energy and food out, that's actually coming down very quickly. So I don't see the inflation, although of course you're right about commodity prices, and there's also a recursive function there. You take oil that high, you actually put the economy into a recession. So a couple things. I was taking notes just so I don't lose track of all this. On the Powell appointment, I agree. I think at this point it's going to be Lael Brainerd, and the resignations of the two regional reserve bank presidents just pulled the rug out from under Powell. Complete politically. I'm talking about the economic effect. I don't think it would be that great, but politically, it's a very big deal. It gives the Biden administration the cover they need to put Lael Brainerd in there. To me, the biggest single factor was not those resignations, although that's a big deal. I'm not understating it. It was when Elizabeth Warren came out and said, we can't have Powell. I forget her exact phrase. She's a threat to humanity. Something.
He's a dangerous man.
Dangerous man. Yeah, well, dangerous to Elizabeth Warren. But yeah, so I think that was the last nail in the coffin. Having said that, I don't think it matters. Lael is the only one who understands international economics. It's a real, void in the Fed. They go into the boardroom and try finding someone who understands, foreign exchange markets or international economics, or the extent to which inflation and other phenomena are moved through international markets, exchange rates and currency wars and all that. She's the only one who kind of gets that, so that's a plus. Yellen is clueless; she has no idea. So that's probably a good thing in terms of the intellectual caliber, but it really doesn't matter. And the Biden administration has shown that they'll bow to the left. This whole idea, Joe Sixpack from Scranton, Pennsylvania. It was a good campaign meme or theme or whatever you want to call it, but it's nonsense. We saw that when a small mob of activists chased a United States senator into a woman's room and filmed her while she was in the stall, closing the door, flushing the toilet, coming out of the stall, berating her. It turns out the Democrats have 50 votes in the Senate. They need all 50 plus a tiebreaker, which is Kamala Harris. She's the vice president. She's president of the Senate, the way we have it. You need all 50 votes. You can't lose one. Well, the senator they chased down into the ladies' room is one of the votes they need, Kirsten Sinema. So it's like, oh, okay, you need her vote to do anything you want. You need her desperately. And your idea of persuading her is to have a mob chase her into a ladies' room and embarrass her publicly. Not such a good idea. That's just stupid. But that's what's going on. And they surrounded Joe Manchin's yacht with They call it a yacht. I mean, I don't know, it might have been a 40-foot boat or something, but they were out there in kayaks, berating him and all that stuff. So this is the kind of this silliness bordering on stupidity, or I would say it is stupidity going on in the U.S. political arena. But having said that, Biden's reaction was, well, that's part of the process. Actually, it's not part of the process. Vigorous debate, a little bit of, sharp elbows, that is part of the process, but not what's going on. So, and when it came to the showdown between the House progressives on the 3.5 trillion, it was really a welfare bill. It's all, they call it human infrastructure. It's just a euphemism for welfare and benefits that they intend to make permanent. And then on the Senate side, Manchin, whose vote you need, Sinema's kind of kept her own counsel, but Manchin's like, I could get there with 2 trillion, but forget the 3.5 trillion. And Biden, through Ron Klain, his chief of staff, signaled to the House progressives, no, you guys are on the right track. Stick to your guns. Like, okay, so you're blowing up your biggest domestic policy initiative by kowtowing to progressives, and then you lose the one indispensable vote in the Senate by kowtowing to the mob. This is all in the course of 48 hours. But without kind of dwelling on the stories, what it tells you is that the White House is enthralled to the progressives. And what that tells you is that when Elizabeth Warren wants Powell gone, then Powell's probably gone. So I think that's right. Having said that, Kevin said the Fed's not as important as most people think. I agree completely, except I'll raise that by an exponent. The Fed's irrelevant. The Fed is irrelevant and impotent. Now, if you're a trader and you want to make money in the Eurodollar futures curve, yeah, pay attention. And the kind of things Kevin was saying, I think, are exactly right. And you can make money as a day trader in Eurodollar futures. But if you're thinking in terms of macroeconomics, if you think in terms of growth, if you think in terms of what's driving the economy, what really matters, the Fed is again irrelevant and impotent. Irrelevant, they can't do anything, and impotent because it doesn't matter if they try. So. And as far as the dots are concerned, Ronnie, you got that right, but it's worse than that. At least it's worse. I happen to have had some, long drawn out conversations over more than one bottle of wine with the guy who does that, the guy who writes I'm not talking about the PR department. I'm talking about the guy who frames the magic words, patience or, progress, the guy who writes that stuff. He's advised, probably sitting in the lap of Ben Bernanke, Janet Yellen, and now Jay Powell, and no doubt Will Brainerd. He's like the mafia, you try to get out and they keep bringing you back in. So this is the guy who knows more about this than anybody. And he told me, he said the dots are a joke. No one inside the Fed takes them seriously. We wish we had never started it, but we did, and now we can't get away from it. So it's good. And this is from the guy who writes the dots, right? So he said to me, so yeah, it's good fodder for CNBC. It's good fodder for financial television or whatever. And then I love the way Wall Street, they take all these dots, each one of which is irrelevant and probably wrong, and then they average them to come up with some central tendency. Here's where the economy is going. That's a joke on a joke. So let's forget the dots again, unless you're kind of a day trader. So the dots don't matter, the Fed doesn't matter. But let me be more specific about why, because I don't like to make declaratory statements like that without explaining it. The answer is velocity. In other words, I try to keep the math simple. $7 trillion times zero is zero. At least where I went to school. I don't know what they teach today, but the point being, $7 trillion of M0 times zero velocity equals zero nominal GDP. If you don't have velocity, you don't have an economy. And that's the problem. They can print all the money they want. How do they print money? Well, we know how they print money. They call Goldman Sachs. They say, I'll pay 10-year notes. And Goldman Sachs give them a price, treasury bills or whatever. And they say, done. And Goldman or Morgan Stanley ships the bills to the Fed, and the Fed pays them with money that comes out of thin air. That's how they create money. Okay. But what do the banks do with the money? They give it back to the Fed as excess reserves. That money is sterilized. It is not being lent. It is not being spent. People are not borrowing. Savings rates are at decade-long highs. So even when we hand out checks, do they spend some of it? Yeah. Do retail sales go up for about a month? Yeah, but actually most of it's being saved. People are saving. This is what's called precautionary savings. We're saving for a rainy day, if you want to use the vernacular. They're not spending the money on average. Some people have a higher marginal propensity to consume, but most of it's not being spent. About 3/4 of it is being saved. So the point being, the Fed can print all the money they want. You can understand money printing as a desperate effort to keep up with the decline in velocity, because nominal GDP is this times this, right? It's money supply times velocity. Again, it's an identity. It's very simple. Well, velocity is dropping, which it is, has been for 10 years or 20 years, depending on which money supply. There's different velocities for different, M0, M1, M2, et cetera. Depending on your money supply, it's either been declining for 10 years or 20 years. But even taking M2, which has been going down for actually about 13 years, you look at the first quarter of 2020, and that was the worst part of the pandemic economic impact. It was a cliff dive. It went straight down. So in the last 10 years, it's gone from round numbers about 2.8 to 1.2. That's scary. I mean, you get below one. Now you're in a world where $1 of printing doesn't even produce $1 of GDP, let alone any kind of multiplier. You're actually causing GDP to go down once that number gets below one. So, and that's what's happening. So that's why there's no inflation. Okay, April, May, June, July ran a little hot. Those are 50% of that approximately were base effects. And some of it was real, but supply chain had a factor. Supply chain is easing. It has not gone away. It's still a big factor, but it is going away. The base effects have completely gone away. Watch the numbers. Over the next couple of months, you'll see them come down a lot. Best leading indicator of that, the Atlanta Fed GDP now, which is not perfect, but pretty good. It's better than anything else I've seen. If you go back to May. Their second quarter forecast went from 13% to 7.5% by the end of July for the second quarter, because it was a month lag. The actual was about 6.5%. So they were kind of close, but that trend was down. Then they started the third quarter estimate around 6.5, kind of where the second quarter came out. Today it's 1.3, and I'll tell you this, you have to understand how they do that. It's not a typical Wall Street Fed forecast where you have some data and then you extrapolate and then you make up the other data based on regressions, which don't mean anything more because we're kind of living in a new world. What the Atlanta Fed does, they take the data they've got. They say, what would be the best estimate of GDP now based on what we have now, without guessing as to filling in the blanks. And then that gets more and more accurate as you get further into the quarter, because they fill in more of the blanks, but they don't make it up the way Wall Street does. So what that means, and here we are in mid-October, we'll have the number on October 28th for this third quarter ending September 30th. But if they started the quarter at 6.5 and they're at 1.3, that means the latest data is possibly negative, because that's an average, right? So you have to have terrible results right now to take the 6.5 down to 1.3. But if you say, where are we right now? You're bordering on recession. So I'm not forecasting recession, maybe not, but those are very, very kind of scary numbers in terms of growth. That's one reason why we're not going to get any inflation. But this is stuff that a lot of analysts, and there's a lot of data out there, and everyone has their favorites. But thank you, Ronnie, for mentioning my name in the same sentence with Rosie, because I agree with you about Rosenberg. I watch him very closely, and thank you, Kevin, for mentioning me with Gary Schilling, because I know Gary pretty well. And he's my favorite beekeeper, and but he's also very. I follow his work very closely, so that's what we're looking at. So just to kind of sum up, the Fed is impotent and irrelevant unless you're a dollar futures day trader, because of velocity. And they can't control velocity. Velocity is a psychological factor. How do we feel? You want to go out to dinner tonight, take your friends, drinks on me. That's one state of the world. You want to stay home, watch TV, and leave your money in the bank? That's another state of the world. The second one has velocity of 0, because I didn't spend my money. So, and that's what we're up against. Now, Kevin gave a really good summary on fiscal policy, but let's talk about that for a second. So before COVID, at the end of 2019, the baseline budget deficit forecast for fiscal 2020 and fiscal 21 was $1 trillion per year, which was high. I mean, Obama was kind of at the $1 trillion level in 2009, 2010. By the end of his term in 2016, they had got that down to around 500 billion. So, okay, nice job. Trump kind of started increasing it again, not quite the fiscal conservative people imagine. But the forecast for 2020 and 2021 from the Congressional Budget Office was 1 trillion. So your baseline is 2 trillion over the 2 years. Okay. So then Trump in June 2020 does I'll use round numbers, a $2 trillion bailout. That's when everyone got their $1,400 checks or whatever. Trump, again, in December 2020, on his last couple of days in office, does another trillion. I think it was actually 900 billion. And that was another $600 check. Okay. Biden comes in, and in February 2021, he does 2 trillion. This is the Biden bailout plan. That's another 2 trillion. So right there, 2 trillion baseline, 3 trillion for Trump, 2 trillion for Biden. You got $7 trillion. And by the way, Kevin's right. A lot of these are multi-year and some of them involve investment. Got it. But these are the numbers we're talking about. Now, since then, the Senate has voted on a $1 trillion infrastructure bill. That's more deficit spending. There's no revenue coming in, other than baseline stuff. And that Nancy Pelosi is holding it hostage, so we'll see. But that'll probably get done. There's bipartisan support for that. And there's a $3.5 trillion welfare bill on the table, and that's not going to be 3.5 trillion, but it's probably going to be 2, because even Manchin said, I'll do 2. So let's call it 2, even though the bill was 3.5, and that'll get done somehow. That adds up to $10 trillion in deficit spending. What was the accumulated deficit from George Washington to Donald Trump on December 31st, 2019? The answer is 22 trillion. So you've increased the national debt you will have over a multi-year period, granted, by almost 50% in 2 years versus 22 trillion in 270 years. That's what we've done. And that's going to take the total deficit to 32 trillion. It's going to take the debt to GDP ratio to 135%. You know who's at that lunch table with you at 135%? Lebanon, Greece, and Italy. That's, and Japan is their world of their own, but that's the only out. Japan's an outlier, but Lebanon, Greece, Italy, and the United States. The Americans like to make fun of like Spain and France. Like, you guys are socialists, you spend too much money. No, France is like 90%. That's high. Spain's like 100%. That's high. Not 135%, which is where the U.S. is heading. Now, I agree with everything Kevin said. I'll just raise it, see you and raise it a level, because it's actually worse than that. But here's where I disagree with Kevin. None of this is stimulus. They call it stimulus, again, pick up the Wall Street Journal, watch CNBC, stimulus. It's not stimulus. It has no stimulative effect. It is deficit spending. It does increase the debt to GDP ratio. It is real money, and it is modern monetary theory. I doubt the typical member of Congress has ever heard of modern monetary theory and can't even articulate it, although articulation is painful because it's so. I know Stephanie Kelton, she's the big brain behind this, and professor at State University of New York. She is the Bernie Sanders whisperer. She was Bernie Sanders' economic advisor in the 2016 campaign. She was his economic advisor in the 2020 campaign. She's not just another ACA. Nice lady, by the way, big brain, but she's not just another ACA. She is Bernie Sanders' economic resource. Bernie Sanders is the chairman of the Senate Budget Committee. He's not just nobody. He's the gatekeeper on all fiscal spending when you have a serious case of cognitive decline and senility in the White House, right? So don't underestimate Sanders' role in all this. And she's Bernie Sanders' economic brain. So that's what we're dealing with. Average member of Congress doesn't know anything I just said. They don't know it, but they're doing it. The point is, whether you know it or not, whether you can articulate it or not, whether you read her book or not, I recommend her book. Again, just to see how silly it is, you got to read her book. No, she says, and this is her from her book. This is not my version of it. That we don't need a bond market to fund deficits. That the existence of the bond market is a favor to investors because it gives you a place to put your money, but we don't actually need one. All you have to do is give wire instructions to the Fed for Lockheed, Boeing, et cetera. And the Fed can wire the money directly to Lockheed to pay for the F-22 Raptor. I mean, she says that. It's like the bond market. Why do you need to issue bonds to pay for things? Just give the Fed the wire instructions and have them send out the money. And we don't need a tax system. And Kevin said, well, maybe we'll raise taxes to pay for that. That's probably right. She said, but no, we don't need a tax system to pay for things. All we have to do, again, just tell the Fed to send the money. And so why do we have a tax system? Well, she would say, well, it's to redistribute wealth, of course. Take it from the rich and give it to people who don't have it. And just in case there's some inflation, you might dial it down with high taxes. I get it. Right, Stephanie. So we have inflation, declining growth. You think raising taxes is your cure? Well, I'll leave that to her, but that's what's going on in Washington. Now, here's why it won't work, because the research, and here I'll look to Ken Rogoff at Harvard and Carmen Reinhart. She was at the University of Maryland, who's at Harvard briefly. She's now chief economist for the World Bank. Carmen on her own with associates, and Kevin and Carmen together have done a ton of research on the impact of high deficits on fiscal growth. And what they've shown, developed economy, developing economy, short time frames, long time frames, 100-year frames, 800-year frames, every time they look at it, they come out with the same result, which is that if there is a Keynesian multiplier, and there probably is, although query whether you're just bringing growth forward rather than actually creating net new growth. But yeah, if you're in a big enough rut, you got to climb out of it. So let's say there's such a thing as a Keynesian multiplier. It's like everything else. I would say if you don't understand economics, go to Los Alamos or ETH in Zurich. You got to talk to physicists if you want to understand economics, because they understand complex dynamic systems and phase transitions. The economists don't know much. But what it shows is that 90% debt to GDP is what a physicist would call a phase transition, through the looking glass, again, common language, the tipping point, et cetera. I don't like that phrase, but that's what it is. Above that, it's diminishing marginal returns to the point of 1 and then below 1, meaning at 30% debt to GDP, which is a very comfortable level if you do some more deficit spending. For every dollar spent, you borrow a dollar, spend a dollar, you might get $1.25 of GDP. But then all of a sudden it's like $1.10, then it's like $1.05. But once you go past 90, you borrow a dollar, spend a dollar, and you get like 90 cents of GDP. Well, what are you at 135? Well, you're 135% debt to GDP. You might borrow a dollar, spend a dollar, and get 50 cents of GDP. In other words, you're increasing the debt, you're increasing the debt to GDP ratio, you're decreasing the Keynesian multiplier, which is already below 1. So in other words, negative growth relative to the spending. The one thing you're not getting is growth. And so Kevin's exactly right about the deficit path. And I would say that where we are in the debt to GDP ratio curve, not only is that not stimulus, what you're going to get, because people look at it, they use common sense. They're like, you know what? I always say when it comes to your own money, everyone has a PhD. People look at this, and what they do is they save more. They save more. And eventually they'll get into gold and hard assets, which, again, I agree with Kevin on, because it can only end one of several ways. There are only a couple ways for this to end. One is default, like, okay, we're just not going to pay you, okay, Argentina. The US won't do that, doesn't have to do that, because as long as you can print the money in the same currency as your debt, there's no reason to default. You just print the money. And MMT actually says that. So we're not going to default, okay? But there are a couple other ways out. One is inflation. And by the way, Kevin said I'm in the disinflationary camp, which I am, but he used the phrase at one point long term, which I'm not. So right now, yes, count me as a disinflationista, not an inflationista. That's absolutely right. But you look out, this is what we do because, if you have the right models on predictive analytics, you look out to 2023 and beyond, I would expect decades of high inflation. Decades of high inflation. but we're not there yet. We got to get through the bottom of the trough. So I would say we're still in a disinflationary environment. You guys, all of you have said several times, real rates are going down, which is a good for gold. Actually, real rates are going up. And the reason is nominal rates have gone up, but inflation is going down. So the real rate's going up. Now, and Kevin said something I thought was the most important thing on this call, and I agree completely. He just said, you got to have negative yields to get out of this. And Kevin is exactly right. You need negative yields. But let's talk about negative yields. In 1980, I took my first mortgage buying a condo in New York. Actually, it was a car in New York. And my mortgage was 13%. And I told my mother, and she cried because her first mortgage was 2%, in the 1950s. And I said, and Mom's like, why are you paying 13%? I said, Mom, I'm paying 13%, but inflation is 15%. And I was living in New York where the taxes at the time were 50%, 50, and the mortgage interest was tax deductible. So my real after-tax cost of borrowing was -8. Because my 13 was really 6.5. 13 was like 6.5 because I had a 50% tax rate, and then two more for inflation, because inflation was 15 and rates were 13. So my real rate was -8.5. That's a negative real rate. That's kind of rate that gets people rocking and rolling. But real rates, first of all, right now are positive because again, when you start talking about real rates, it's obviously it's nominal yield minus inflation, but there are 50 different versions of yields and inflation. So I think you have to be specific. I look at the 10-year Treasury note yield to maturity, and most people don't. I use it because I think it's a good proxy for a long-term investment. But if you're looking at LIBOR or Fed funds or something, you get a different result. I'll grant that. But I use the 10-year yield to maturity on the 10-year Treasury note compared to PCE core year over year. And if you take those numbers, real rates are slightly negative, but they're going up fast because inflation will be dropping very quickly. And as far as Kevin's a bond bear and he's got a lot of company. I'm a bond bull. When I say bond, I'm talking about government bonds and benchmark notes in particular, 10-year Treasury note, or the equivalent in the bonds or JGBs, et cetera. But on the 10-year Treasury note, I'm a bull. Rates have backed up to 1.5%, but on March 30th, they were 1.745. So in my view, it's a backup in a downward trend. And I would look for that yield to maturity to be down around 1.2 or lower by the middle of next year, and maybe even go into 90 basis points. And by the way, Kevin said something else that is like absolutely mark it down because I agree completely. See, the Fed's going to taper in November. All the data is pushing the other way. The Atlanta Fed GDP I just mentioned would be a good reason to hit pound the brakes. But the Fed, first of all, is always wrong. You have to pay close attention to the Fed because it's a great forecasting tool because they're always wrong. They don't turn easily. They do not move quickly. So when they set themselves on a path, it's like it's like they're throwing a ball. It's going to go a while before it changes course. They're going to stay on that path. Now, do they change? Yeah, but it takes 6 or 7 months of data and 6 or 7 months of debate to get the Fed to change. One of the greatest blunders in history was the tightening from 2015. They raised the Fed funds rate. That was the famous liftoff. They waited a year to do it again because they didn't want to be embarrassed in 2016. But by 2018, Yellen and Powell together had got it up to, I think about 2.25, 2.5, maybe 2.25, whatever that range. What happened? From October 1st, 2018 to December 24th, 2018, the stock market fell 20%. That bottomed out of the Christmas Eve massacre. And then Jay Powell got religion, gave a speech in the week between Christmas and New Year's when nobody was working, and said, "Time out. We're gonna look at lowering rates," and he did. But that's what happened the last time they tried raising rates. They sent the stock market down 20% in 3 months. 3 months.
And actually, gold was one of the very, very few assets doing well in that quarter.
Correct. And so that's going to happen. They are going to start to taper in November. They are going to be on a fast track taper. And again, Kevin's right. My estimate would have been a year, but no, Jay Powell said June. So, okay, June 2022, there you are. And then the Fed's actually highly predictably wrong, but predictable in terms of their action. So they will, when they do this, it's watching the movie in reverse. Like, how do they do it when a panic hits? Well, first they cut rates to zero, and then they start QE. I think we're up to QE6 at this point, and then they sort of slow down. Then they but then they do it backwards. So what's backwards? Tapering, undoing the QE, which is done QT, quantitative tightening. And don't listen to the analysts who say, well, they're not actually tightening because they're still printing. No, again, Kevin's right. Everything happens at the margin. If you print less, that's tightening. Yeah, you're still printing, but as long as you start printing less, you're tightening. Then they get all the way back to zero, meaning they're not buying or selling securities on net. And then, and only then, will they start to talk about raising rates and like, what's the gap? But Kevin's right. By the time we get to the middle of 2022 and the taper's over, if I'm right about the data and the trends and disinflation, et cetera, they may say, hold on, we can't raise rates. And by the way, that happened because the first taper was over in November 2014. And when did they raise rates? December 2015. That took 14 months to do a liftoff that they weren't even sure they would do. By the way, that was the bottom for gold. Gold was 1050 on the 2 days before the liftoff. Gold was 1050 2 days before the liftoff. So in 2015. So I would look for the taper to play itself out, but I would say by the middle of next year, even the Fed will realize that they blundered again, and that there will be no liftoff anytime soon after that. And then, no, they can't cut rates. I don't think they're going to go negative, but I agree with Kevin. They may not have a rate hike. Well, in my view, certainly not in mid-2022, and maybe not ever, because things will be pretty bad. Maybe, we're looking at things, Ronnie, that may not happen in my lifetime. There's no way out. There is no way out of what they've done except inflation, but they've forgotten how to cause inflation. I would say it's a sad day when a central bank wants inflation and can't get it. That means they don't know how to do their jobs. The Fed could get 10% inflation in 15 minutes, but they won't do it. I talk about this in chapter 6 in the conclusion of my last book, The New Great Depression. They can do it in 15 minutes by saying the price of gold is now $5,000 an ounce. The vaults are open at Fort Knox. We're a seller at 40.50 and or 49.50, and a buyer at 50.50. And if you think it's high, come on in. We'll buy it from you. And if you think it's low, the doors are open at Fort Knox. You can have some. But if you do that, then the price of gold is $5,000. You're basically a market maker with a bid and an offer. And if you have enough gold and enough printing press, you can do it, and they do. So. But they won't do that. They won't do what I just said because they've institutionally forgotten that's how the system works. The two people who did do it, one intentionally, one unintentionally. FDR did it intentionally, worked brilliantly in the middle of the Great Depression. Nixon did it by accident, but it also worked, and that's when gold went up 2,700% in 8 years.